Good afternoon, everyone, and welcome to our annual market review / outlook. We take a look back at 2016 and then take a look going forward at 2017. For the year, the S&P 500 was up 9.54%, and with dividends, it was plus 11.90%. The year started on a terrible note. As a matter of fact, it was the worst start to a year ever. Market declined on worries about China, the declining yuan currency, collapsing commodity prices, negative interest rates, and the threat of a U.S. recession. But the U.S. economy held strong. The market started to rally. We had strong payroll reports throughout the year, and then the market closed the year on a post-election rally. In between, we had Brexit, which lots of people thought would lead to a big sell-off. It led to a two-day sell-off, and that kind of started the July rally. We also hit, in the middle of the year, all-time lows on the 10 and 30-year interest rates. But overall, it was a terrific year for the S&P 500 and the U.S. equity markets in general, plus 11.9% with dividends. If you take a look at the Dow Jones Industrial Average, the Dow was up plus 13.8%. You get a view here of kind of like a bell curve of the history of the market, and it was a really solid year, kind of right in the middle in the plus 10% category. You could also take a look at the tail risk with the Dow off to the left in the red circle, and then off to the right, the huge gains you very rarely get, but sometimes do. Here's a periodic table for 2016, and you'll see that the big winner this year was the Russell 2000 value asset class. Notice it was up 31.74%. Last year it was down 7.47%. So it had a big reversion to the mean, and that's a theme as you look through the different asset classes over time. You see periods of underperformance, you see periods of outperformance. So one possible idea for the future is to start putting a little more money into the international markets. You see the EAFE index as well as the emerging markets have been underperformers over the last several years. Let's take a look at style box returns. So off to the right in 2015, you see how everything was down except for large growth. Value was actually the worst performer in 2015. In 2016, you see again the theme of reversion to the mean, and value was the big winner. Looking at sectors, energy and financials, plus 28% on energy, plus 23% on financials. Look at last year, energy was the worst performer. Same in 2014, energy the worst performer. Again, you see the theme of reversion to the mean. Internationally speaking, emerging markets was a winner, plus 11.75%. But you look at the 3 years prior, not so good, minus 15% in 2015, basically even in 2014, and down in 2013. Let's look at commodities. Basically, the energy complex were the winners: heating oil plus 49%, natural gas and crude oil. Losers, cattle and cocoa. Let's take a look now at the economy. This is from the Atlanta Fed, the GDP Now forecast. So as of January 13th, the estimate for Q4 growth was 2.8%. Looking at the New York Fed's Nowcast, this is their estimate for Q4 growth at 1.9%. So pretty much in line with what we've seen over the prior few years, growth in the 2% or so area. Looking forward for the first quarter of 2017, this is from the New York Fed. As of January 13th, they're projecting growth at 2.1%. Here's a BlackRock model. The green line shows where the 12-month consensus GDP forecast may stand in 3 months, and it's a little bit north of 2.5%. So hopefully growth is starting to pick up a little, and if you look around the globe, that seems to be the case. The value of the Chinese yuan, we look at this at every webinar, continues to fall. China has been spending a lot of money to prop the currency up, despite what Donald Trump says, but China's trying to keep the currency higher, because when the currency falls, it leads to a flight of capital out of China. Growth in China, about plus 6.8%. That's the official number. We really don't know how accurate that is, but there is growth in China. It's not in a recessionary mode. China still, though, is somewhat of a black box. They have tons of debt there, and at some point the government is going to have to deal with that. The big thing, though, and everything about the Chinese government, is keeping social stability. So they're going to do whatever they can to keep the economy roughly growing at some moderate pace. This is a look at the Sentex index. It measures investors' sentiment around the globe. And if you look, really, almost everywhere. If you look under the column titled Regime, you'll see boom in Eurozone, boom in Germany, Switzerland, Austria, Eastern Europe, upturn. And to the right of that, where you see the double asterisks, the Eurozone, for instance, it says upturn. That was last quarter at the last webinar. So almost everywhere you see how the economies around the world are improving and sentiment is much more positive than it was just a few months ago. Purchasing Managers Index, they're moving up around the globe. The red line is the composite index. So for December, you'll see how it's been moving up really since the beginning of 2016. So economies around the world seem to be doing pretty well. This is a heat map of the Purchasing Managers Index. And as you go to the right, you'll see more and more green. Off to the left, as you go back in time, you see more and more red. So really outside of Brazil, everything is close to green. So economies, again, are improving around the globe as we head into 2017. This is the composite of leading economic indicators from the OECD, and you'll see everything is sloping up. Here are IMF growth projections. Look off to the left. See the 2016 estimate for global economic activity, plus 3.1%. The 2017 projection, plus 3.4%. And 2018, plus 3.6%. Let's look at oil. If you remember at the beginning of 2016, crashing commodity prices really were one of the big motivators pushing the market way, way down. Oil rallied. At last year's webinar at this time, we showed a graphic, I think it was from 1990. Last time oil had crashed, people predicting that oil would drop to like $5 a barrel at that time. And we were showing how it turned around right when the worst was expected. And that's exactly what happened in 2016. The market started to rally, and slowly inventory levels are going to start equalizing out. So supply roughly is going to equal demand. We think prices will stay about where they are, $50, maybe drift up a little bit, and that should enable companies to at least have some level of profitability and keeping a huge, huge drag on S&P 500 earnings. Let's talk about Trump. You really have to take Trump one day at a time. We really don't know what's going to happen in the future. He has, we think, some really good ideas, and we also think he has some terrible ideas. So one of the things that we do like is deregulation. There has kind of been a feeling among business people that the government has been at war with business in this country, you know, through the Obama period. And even prior to that, there's just been a constant headwind of regulation on business in this country. So if Trump can roll some of that back, we think that would be good for profits. Repatriation, there's lots of dollars held overseas, hasn't come back to the United States because companies would be taxed on it. Trump is going to relax the taxing on that. That should bring lots of dollars back to the U.S. that hopefully will be either reinvested or will be paid out via dividend or buybacks. Either way, it means more money to U.S. citizens and investors, so we think that'll be a good thing. One of the downsides to that is it probably will push up the value of the U.S. dollar, and that'll hurt, you know, S&P 500 companies. It'll be harder for them to export. So there's a negative to that also, but overall we think net-net that is a positive. Corporate tax reform is something we need. I think both parties agree on that. That also should help U.S. companies and the economy. And if we get a tax cut to like 22% or 15%, it's really going to have a huge impact on earnings, which will help make the market a little more moderately valued. As one of the big arguments now we'll get to later is the market is overvalued. One of the things that we don't like, and this is the thing that we fear most about Trump, is his attitude on protectionism. You know, we don't know where this is going to go yet. The risk, of course, is that we get into an all-out trade war. You know, questions about Trump's character, the way he talks to people, the recent episode just this past week with Mexico. That's the kind of stuff that can lead to a trade war. That would be very dangerous. If you look at history, just has never worked out. So that, to me, is the big downside. That's the big risk with Trump. Here's a look at a chart that we keep of corrections of 5% or more since 2005. So the average span between corrections, and again, we're defining a correction of 5% or more, is 105 days. So the last correction, and this chart I think I did about a week ago, it's probably about like 220 days ago. So at some point, there is going to be a pullback of at least 5% or so. Of course, that's just part of being an investor. There are always corrections, sometimes just 5% or so, sometimes 10%, sometimes more. Let's turn our focus now to valuation and start looking at earnings. So here are the estimated earnings for Q4 for the S&P 500. They're estimated to come in at plus 3%. Practically speaking, earnings always come in a little bit higher. Last quarter, we were up plus 3.1%, and that stopped a 5-quarter losing streak of negative earnings. On this slide, we're looking at projected earnings for the S&P 500 on an annual basis, and investors are counting on big earnings increases in 2017 and 2018. In both years, investors are counting on increases of almost 12%. In back-to-back years. Probably those numbers are going to be overstated. It might be more reasonable to split the difference and assume, let's say for 2017, the earnings will come in at 125. But right now, these are the consensus forward earnings estimates. Here we're looking at the S&P 500 forward 12-month PE ratio, and this is as of January 19th. So forward earnings, they're projecting 133.03. So the forward PE is 17.01. If you look at the green dashed line, that is the 5-year forward PE average, 15.1, and the blue dashed line is the 10-year average at 14.4. So based on forward PEs, compared to historical averages, we are overvalued. So what would happen if forward earnings projections remain at 133.03, but the price falls to the 5-year average tomorrow? Well, in that case, the S&P 500 would be priced at 2008. We had that price last in June of 2016. And then if we fell to the 10-year average at 14.4 times, the S&P would drop to 1915. This next slide compares the Shiller PE ratio versus the 10-year Treasury bond PE ratio. Now, there's lots of things going on with this chart. So let's take it one at a time. And first, let's focus on the purple line, which is the Shiller PE ratio. Now, the Shiller PE measures the price of the S&P divided by the average of 10 years worth of earnings adjusted for inflation. So the Shiller PE, and this is as of January 1st, was 27.27, and the 20-year average is 19.79. Well, that's a huge, huge difference. So if the market fell to the 20-year average tomorrow, the price of the S&P 500 would drop dramatically to 1623. That's kind of frightening. Now, practically speaking, the Shiller PE has been way overvalued for a long, long time. And let's try and figure out why. So let's now look at the blue line. So the blue line is the Treasury bond, the 10-year Treasury bond, and we're turning it into a price-to-earnings ratio. So basically, we're taking 1 divided by the interest rate on the Treasury bond. So you can see how the Treasury bond, this PE ratio, the blue line, has gone up and up and up. So the current PE of the Treasury bonds is 40.82, and if you compare that to the Shiller PE of 27.27, you'll see that stocks are a better value, at least based on the comparison of these two metrics, as compared to bonds. And that's the reason why many investors think that stocks right now are not really overvalued. When you take into account interest rates, they're much more fairly valued. This chart is somewhat similar to the previous chart. Here we're comparing what's called the earnings yield between an investment grade bond and earnings for the S&P 500. So if you look at the middle part of the chart, you'll see the BAA bond yield. So that's basically an investment grade bond, the yield on that bond, minus the earnings yield of the S&P 500, and this is for operating earnings. So we're putting the operating earnings in the numerator and the price in the denominator. We're basically flipping the PE ratio. Now, normally, based on history, the bond yield would be greater than the S&P 500 operating earnings yield, but right now it's in the negative. So you look below, you'll see, as of January 19th, the yield on the investment grade bond is 4.7%. The earnings yield on the S&P 500 is 5.8%. It's greater. So this is another argument, another way of showing why equities are fairly valued. Same thing on the chart a little bit further below in the red. This is comparing the investment grade bond yield minus the official GAAP, that's generally accepted accounting principles earning yield. And here again, it's much lower than average. We look at this chart at every webinar. This is the Morningstar median stock fair value. So here, Morningstar rates the value, what they consider the fair value of many stocks. So we're looking at their entire universe here, the median stock in their entire universe, comparing that to their measure of fair value. So as of today, that measure is 1.03. So the median stock by Morningstar is 3% overvalued compared to their estimate of fair value. Here's a chart of the 10-year Treasury yield. It dates back to 1992, and you can see how for so many years the trend has been down, but in the last couple of months interest rates have been going up. So as of January 27th, the 10-year Treasury yield is 2.48%, and that will probably drift higher in the future. The Federal Reserve has said that they're anticipating 3 interest rate increases over the next year. So if that happens, interest rates will probably go up. Last year, though, the Fed anticipated 4 interest rate increases, and they only increased rates 1 time. Interest rates also will probably move higher just because inflation is moving higher with an economy that's expanding faster, plus with some of the policies that Trump is going to put into place, plus with a tightening labor market. These are all factors that are going to push interest rates higher. So what kind of equity returns might be reasonable in the future? Well, to help calculate that, let's do a quick lesson on the composition of returns. So you can look that future returns are a product of 3 different variables. One is the dividend yield, one is the growth rate on earnings, and one is the change in the PE ratio. So let's look at a simple example. Here we have company ABC, and let's assume they have earnings of $10 per share, and they paid a dividend of $2, and the company sells at a PE of 10. So the price today would be $100 per share. That's $10 per share in earnings times the PE of 10 equals 100, and the dividend yield is 2%, $2 divided by $100. So if earnings grow by 5%, what would the price be 1 year from today if the PE doesn't change? Well, that means earnings would now be $10.50. Multiply that times the PE of 10, you get $105 per share. So if you sold ABC 1 year from now, you get $105 per share, and you also received a $2 dividend for $107 total. That means your return is 7%. What would happen if the PE expands from 10 to 12? Well, in this case now, the price goes up a lot. It's now $126 per share because it's 12 PE times $10.50 in earnings. The return would be 28%, which is the $126 for the share of stock plus your $2 dividend divided by 100. So a change in the PE ratio makes a big difference in what your returns are going to be. And of course, this works on the upside as well as the downside. So now, what's going to happen going forward in real life? Well, equity returns, as we said, you have the 3 variables. So the dividend yield, it's about 2% today, and that's going to be somewhat stable. The growth rate, there's a question mark on what the growth rate can be. Is it going to be normal by historical measures, or can it possibly accelerate in the Trump era? And then you have the issue of the PE ratio. Well, the risk-free interest rate is rising. As we just showed before, you saw how the 10-year Treasury is starting to rise. Inflation is rising. The Fed has indicated there are going to be 3 interest rate hikes. So most likely, interest rates are going to be rising, and that's going to slowly push the PE ratio down, or we're assuming it's going to slowly push it down. It could maybe fall even faster. But the era of the PE ratio having the wind at its back, in other words, having interest rates falling, is likely over. That means PE ratios over time are probably going to revert to the mean. So the real question is, how is a stronger growth rate, or at least we hope a stronger growth rate, offset a falling PE ratio? So here are some historical measures of growth rates for earnings in the S&P 500. So the arithmetic average since 1961 has been plus 7.76%. In the last 20 years, since 97, it's 6.83%. You can see all the numbers here, but let's take the lowest number. The geometric mean since 1997 is 5.47%. So here are some samples of what might happen in the future. So today, year 2017, we're assuming the time is year 0. The dividend yield is 2.1%. That would mean a dividend of $47.48 on the price of the S&P, which is over to the right, of $2,261. So if you bought the S&P, and this was the price a few days ago, you're putting out $2,261. Let's go down 5 years from now, 2022. Well, let's assume the dividend yield remains the same at 2.1%, and earnings have grown 5.47% every year. And let's assume that the PE ratio falls from 17 today to 14, which we said is the 10-year average. Under that scenario, price of the S&P would be 2,430, and your cash flow is in the final column. So you see negative cash coming out, 2,261. Then in 2018, you have just received, we're assuming you receive it at the end of the year, $47.48 in dividends, etc. And in the final year, you receive 2,430 from selling the S&P, and plus you pick up $50.46 in dividends from the year before. Under that scenario, your internal rate of return would be 3.56% from today. What would happen if the PE ratio falls to the 5-year average of 15.5? Using the same assumptions as before, except for the change in the PE, the price would be 2690.47 in 2022, and your internal rate of return would be 5.64%. What about if the PE remains the same at 17? Well, in that case, your internal rate of return would be 7.57%. Now, we're not saying that any of these three scenarios are likely to happen. We're just trying to show you the interplay between the three different variables of dividend yield, growth rate, and PE. So where is the market going to go from here over the short term? Of course, nobody really knows. There are lots of factors that can push the market down or push it up. On the positive side, you have corporate tax reform, repatriation, deregulation. The global economy is getting better, and the U.S. economy seems to be getting a little bit better also. On the downside, you probably have falling PE ratios, rising interest rates. There's geopolitical and terror risk all around the world, and if protectionism is not handled in a proper manner, it could turn into a trade war. That we think would really hurt the market. The big factor is what we call the Trump wild card. He has so many different policies he's putting into place so quickly, there could be unintended consequences that possibly could push the market up, or they could push the market down. So we think the Trump wild card could tilt the market up or down. Big thing to remember is that over time, equities have been a good place to be. There are always corrections. Markets fall, markets rise, but in the long run, they tend to go up. Anyway, thank you for joining us today. If you have any questions, please contact us at the email addresses below. And also be sure to keep track of our weekly newsletter. That way you can be filled in on what's going on in the markets in between our different quarterly webinars. Thank you very much, and thank you for listening.